So we can proceed to the elements. Can proceed to discuss the elements. Let me discuss the elements here. Elements of accounting, elements of financial statements, elements of financial statements, elements of financial statements. Now, candidates, financial statements, before we look at the elements within the financial statements, it's important for us to understand that financial statements are formal records that provide a comprehensive overview of a company's financial activities and position. So financial statements are formal records that does what? That provide comprehensive or detailed overview of a company's financial activities and position. And these financial statements, candidates, comprise several essential elements that work together to paint a complete picture of a company's financial health. You understand? And the main financial statements include the balance sheet, or what is popularly known as the statement of financial position. So the statement of financial position or balance sheet has elements. Then we have another financial statement known as income statement. Within that income statement, there are also elements. Then you have the cash flow statement and the statement of changes in equity. So we want to analyze the elements of financial statements, beginning with the statement of financial position. So one financial statement is one statement of financial position, popularly known as the balance sheet. So this balance sheet has various elements, one of which is assets. One element, assets. Assets. That's the first element you will find in a balance sheet. If you have to look at any balance sheet, the first thing that will strike you is assets. And assets are resources that are owned and controlled by an entity that have future economic value, like cash, inventory, property, equipment, land, buildings, motor vehicles, and so on. Those are assets. They are owned and controlled by a company. If a company has assets, then those assets must be owned by the company. If it is motor vehicle, then the company must have ownership and control of the motor vehicle. Okay? If a company has an asset known as land, that is to say that there has to be evidence that the company owns that land. Evidence could be the title deed. And the company should also have control over such an asset. So the first element in a statement of financial position is assets. And I'm defining assets as resources owned or controlled by a company that have future economic value. The second element is liabilities. liabilities, liabilities, liabilities. Now, liabilities are obligations or debts owed by an entity, external parties. So a liability is an obligation or debt owed by an entity to external parties. For example, a loan. If a company has a loan, that loan is a liability. Another one is accounts payable, also known as creditors. If a company has creditors in its books, if a company has creditors in the balance sheet, then that amount of creditors represents the debts that the company owes, say suppliers. Do you understand? We may have things like bonds. Bonds are long-term loans, okay? Short-term loans, long-term loans, accrued expenses like unpaid rent, unpaid salaries, unpaid taxes. Those are accruals. They are also part of liabilities. So that is the second element of the statement of financial position. The third element is known as capital. Capital, 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 or equity, equity, the equity. What is equity? Now, equity is the residual interest in the assets of a company after deducting liabilities. So if you have assets and liabilities, when you deduct these liabilities from the assets, what you have is capital. You understand? That's equity. Capital or equity. It is the residual interest in the assets of a company after deducting liabilities. It represents the owner's on the company's assets, the owner's claim on the company's assets. And equity includes what you call common stock, retained earnings, share premium, reserves, and so on. You understand? So the balance sheet has three main elements: assets, and as we be continuing in our studies, we'll look at the categories of assets. We have the short-term assets and the long-term assets, or the current assets and the non-current assets. We'll also be studying, as we move along, the different categories of liabilities. We have the short-term liabilities, we have the long-term liabilities. Capital, we have different forms of capital. We have common stock. Common stock is also known as ordinary share capital. We have retained earnings. There is a share premium. We also have reserves. You understand? But these are the main elements of the balance sheet or statement of financial position. Now, the second statement, because currently we are discussing elements of financial statements. The second statement is statement of profit or loss. Statement of profit or loss, or simply the income statement. Income statement. The income statement. Statement of profit or loss, or the income statement. You understand? And it is the income statement that helps us understand or know the profitability of a company. And one element of income statement is revenue. Revenue. Revenue or sales. Okay? Revenue. Revenue is the income generated from the sale of goods or services or from other activities such as investments. Revenue can be received from selling of goods and services. Revenue, what the company receives in form of after selling goods or services, that is revenue. Then we also have expenses as another element. Expenses. Expenses. These are costs that are incurred in the process of generating revenue. For example, rent, salary. We have stationery, advertising, cost of goods sold, and so on. Delivery costs, transport costs, internet costs, telephone costs, water, electricity, name them. Those are costs that are incurred in the process of generating income. If you are operating a business of, say, a supermarket, in the process of selling, before you sell, there are other expenses that are incurred. You need to transport the goods to the stores. You need to pay people who are selling at the counters. You need to pay the accountants. You need to pay expenses like electricity. You need to pay water. You need to pay food. You need to pay. For you to sell, there are other expenses that are incurred. So expenses that are incurred in the process of generating income is what we are referring to as expenses. These are costs incurred in the process of generating revenues. You understand? Utilities and so on. Net income. Net income. Net income. Now, net income or net profit is the difference between revenues and expenses. And net income represents the company's profit or loss over a specific period of time. So the difference between revenues and expenses is what we are referring to as net income. So in an income statement, you'll have revenues, you'll have expenses. These expenses may also be categorized differently. We shall be looking at such categorization as we move along. Then the third statement. The third statement is statement of cash flows. Statement of cash flows. Statement of cash flows is a statement that helps the users understand the flowing of cash. It represents the cash inflows and the cash outflows. The first element is the operating activities. Cash flows from operating activities. Cash flows from operating activities. We have cash flows from financing activities. And this could be cash inflows or cash outflows. The third element of a statement of cash flows is the investing activities. I should reverse this. We have investing and financing activities. Operating activities, investing activities, we have the financing activities. Okay, these are the major elements of statement of cash flows. operating activities. What are these operating activities? Now, operating activities, cash flows from operating activities or operating activities, these are cash flows related to the core business operations, from the word operating, core business operations of the company, such as sales, purchases, such as payments to employees, and so on. Those are cash flows that are related to what? That are related to operating activities, related to the core business of the company. Then we have investing activities. Investing activities. What are these investing activities? These are cash flows related to the acquisition and disposal of long-term assets such as property, equipment, and so on. Investing. When a company purchases plant, motor vehicles, the non-current assets, the long-term assets, that's what we're referring to as investing activity. When a company sells or disposes motor vehicles, land, equipment, and other non-current assets, that is also investing activities. So investing activities refers to activities related to the acquisition and disposal of long-term assets. Then lastly, the other element is financing activities. Financing activities. These are cash flows that are related to the changes in company's capital structure. Changes related to company's capital structure. Do you understand? Such as issuing of common stock or ordinary share capital. When a company issues ordinary share capital, or when a company repurchases ordinary share capital, then that is a financing activity. When a company borrows money, okay, borrowing of loans, that is a financing activity. You understand? When a company repays loans, that is a financing activity. So the cash flow statement, the statement of cash flows provides insights into how a company does what? How a company generates and uses cash, which is important for assessing the liquidity and the financial stability of a company. So this is statement of cash flows. The other statement we need to consider is the statement of changes in equity. The third statement or fourth statement is the statement of changes in equity. 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 Changes in equity. Candidates, we are studying the elements of financial statements. The first statement is statement of financial position, also known as the balance sheet. The second statement is the income statement. We have the statement of cash flows, and now we want to identify the elements of statement of changes in equity. Statement of changes in equity. And we recall, candidates, we defined here equity as comprising the ordinary share capital, the share premium, the retained earnings, reserves, and so on. So the first element, if you are to have a look at any statement of changes in equity, the first thing you will see is the beginning equity. Beginning equity. Beginning equity, or the balance brought down from the previous period. The balance brought down. The balance at the beginning of the accounting period is what we are referring to as the beginning equity. Beginning equity. This is the equity balance at the start of the reporting period. Then you'll have 2, the net income, or the profit for the year, the net income. This is the profit or loss for the period, the profit or loss for the reporting period or for the accounting period, which increases or decreases equity. If it is a positive, if it is a profit, it will increase this equity. So you have the beginning equity, you add on the net income. If it is a positive, it will increase this equity. If it's negative, it will reduce the equity. So we have the profit or loss for the year, for the reporting period, net profit for the reporting period. You understand? We may also have other comprehensive income. Other comprehensive income. Other comprehensive income. These are changes in equity not included in the net income, all right, such as unrealized gains or even losses on investments. You may have dividends as part of statement of changes in equity. Dividends. These are distribution of profits to the shareholders, which decreases equity. Five, stock purchases. Let me say, first of all, stock issuance, stock repurchase. Stock issuance or repurchase. These activities that increase or decrease equity through changes in the number of shares outstanding. You understand? If the company issues shares and shareholders buy the stocks, that will be part of the statement of changes in equity. If the company repurchases the stocks that were previously issued, then that again is part of the statement of changes in equity. So candidates, we are just highlighting, but as we move on with the subject, we'll be delving deeper into these elements. This is just introduction. We are introducing the elements of financial statement. We are just mentioning, but as we move along, we'll be looking at illustrations on how to prepare the statement of financial position, income statement, statement of cash flows, and also statement of changes in equity. But it's important for us to acknowledge that these financial statements are interconnected and they provide a holistic view of a company's financial performance and position. Because we know that the net income from the income statement flows into the statement of changes. This net income, it flows, you can see after preparing the income statement, this will flow. This is part of that. So they are interconnected. Just giving an example. Okay? It flows into the statement of changes in equity. It also reflected in the balance sheet. This one, we shall see later on, is also part of the balance sheet. So they are interconnected. Some of these elements are interconnected. And the statement of cash flows explains the changes in the cash balance in the balance sheet. This one. This statement explains the changes in cash in the balance sheet under the assets, because the cash is part of assets. So this statement explains the changes in cash and cash equivalents in the balance sheet. So you see, there is that interconnectivity, right? There is that interconnectivity. So by analyzing the financial statements together, stakeholders can gain a deeper understanding of a company's financial health. They can make informed decisions, and they can assess the company's future prospects. Is that clear?